Historically, insurance companies have used two types of sales representatives to sell their products. Career, or captive, agents employed by an insurance company to sell only that company's products. Independent insurance brokers who sell insurance products for two or more different companies. When it comes to the duty owed the insurers they represent and the customers they serve, the similarities between agents and brokers outweigh the differences. For that reason, most state insurance regulations today refer to agents and brokers collectively as producers. The law of agency. All producers are bound by the law of agency, a set of common law rules that define the legal relationship between two parties, a principal and an agent. The law of agency authorizes agents to act on behalf of the principal in negotiating and creating legal agreements with a third party. In the insurance field, the insurance company is the principal and the producer is the agent. The law of agency makes clear that producers' actions are generally binding on the insurance companies they represent. The producer's duty under the law of agency. Producers are expected to use reasonable care in serving and protecting the interests of the insurers they represent. In fulfilling their duty, producers are required to solicit business that is acceptable to the insurer, carry out authorized activities with reasonable care, fully disclose to the insurer all pertinent information that affects the placement of an insurance policy, including knowledge of the applicant's current health and health history, make full disclosure of all known facts when completing claim forms, avoid conflicts of interest, follow through on business transactions within a reasonable time, fully account for premiums and submit them to the insurer on a timely basis, never commingle premiums with personal funds or use them for personal expenses. The law of agency does not relieve producers of responsibility to their customers. It is generally accepted that all producers have a fiduciary responsibility to act in good faith and integrity both with consumers and insurers. Producer's authority. In an agency relationship, legal authority is given to the agent to act on the principal's behalf. When the agent acts within his or her authority, those actions bind the principal. There are three levels of producer authority, traditionally called agent's authority, that may bind the insurer. Express authority, implied authority, apparent authority, express authority. The contract between the producer and insurer sets forth certain acts and duties the producer is expressly authorized to perform. This is express authority. Implied authority. For the sake of effective business practices, insurers allow their producers to engage in many sales-related activities not expressly listed in any agreement but that are recognized as essential to the job. This is implied authority. Apparent authority. Apparent authority, the third level of binding authority, is the one that is most likely to lead to problems for both the insurer and the producer. It is authority that the contract does not provide, the insurer does not intend, reasonably appears to the customer to be granted by the insurer based on the producer's statements and the actions, or inactions, of the insurer. Notice that the insurance company's actions or inactions play a role in determining if it is bound by a producer's actions. If a producer fraudulently does or says something that is absolutely without the insurer's knowledge or permission, that action may not be binding on the insurer. However, if the producer's actions reasonably appear to be done with the insurer's knowledge or silent acceptance, then the actions are binding, even if they are not permitted. Example. Consider Joe, a life insurance producer, and his exercise of the three levels of agent's authority. Express authority. As expressly written in his producer contract with the insurer, Joe executed the sale of a life insurance policy by meeting with a prospective client, reviewing her financial needs, recommending a life insurance product, and assisting her in completing and signing an application. Implied authority. Prior to meeting with the prospect, Joe had mailed her some insurer-approved promotional material and called her to request and schedule a meeting. Though these actions are not expressly listed in his contract, the authority to do them is implied as a normal part of a producer's job. Apparent authority. 6 months after the policy was issued, the client misses a premium payment by the end of the premium grace period. Although the insurer has strict rules about not accepting late premiums, Joe accepts her late payment and tells her the policy will not lapse. He mails the check to the insurer, who processes it several days later instead of lapsing the policy. What happens if the client dies while the insurer is processing the late payment? By not lapsing the policy, the insurer must pay the death benefit since it supported Joe's apparent authority to accept the late premium payment. Producer responsibilities to applicants and policy owners. Producers have important responsibilities to insurance applicants and policy owners. Chief among these duties is to act in the customer's best interest with every insurance transaction. In addition to the fiduciary duty to protect customer premiums and assets, producers are expected to avoid rebating in any form. Rebating is refunding or offering to refund a portion of the premium or anything of value in return for the applicant's purchase of a policy. Make sure all product recommendations are suitable for the customer. Avoid replacing an existing policy unless the replacement is clearly in the customer's best interest. Disclose all information that pertains to the proposed policy. Avoid misrepresenting the terms or conditions of a proposed policy. Buyer's Guide and Policy Summary. To guide prospective buyers in choosing the most appropriate type of coverage for their needs, most states require producers to provide a buyer's guide to all prospects. The buyer's guide explains the general features, benefits, and conditions of the type of insurance being considered. Most states require that the guide be provided to a prospective buyer in the first meeting with the producer. Many states require that applicants be given a policy summary before the application is signed. This document summarizes detailed information about the specific policy being purchased. Agent errors and omissions insurance. Like other professionals, insurance producers can obtain insurance coverage that protects them from liability that may arise in the conduct of their business. Known as errors and omissions, or E&O, insurance, it covers injuries and damages that occur due to professional services a producer rendered or failed to render. An E&O policy covers the insured producer for the cost of damages, whether real or alleged, incurred by a customer. E&O coverage includes legal defense regardless of the merits of the case. Key point: E&O coverage does not protect against willful misconduct. It will protect the producer who is sued because a mistake was made. It will not protect the producer who willfully engages in an unfair trade practice. For your review. Most states now refer to agents and brokers by the collective term producer. Producers must act in good faith and with integrity in their dealings with both their customers and their principals. Producers may never commingle premiums with personal funds. There are 3 levels of agent's authority: express, defined in agent's contract; implied, accepted part of the job; and apparent, non-approved actions that can be binding on the insurer. The buyer's guide explains the general features, benefits, and conditions of the type of insurance being considered. The policy summary provides detailed information about the specific policy that is being purchased. Errors and omissions, E&O, insurance protects producers who are sued because a mistake was made, but does not protect those who willfully engage in an unfair trade practice. Please pause the audio.
To sell insurance, we've described 2 different types of people, agents and brokers. And there is technically a distinction between the two. The technical distinction is that an agent, in the typical agent-principal relationship, is somebody that represents the insurance company exclusively, whereas traditionally a broker was seen as somebody that represented the customer. And as representing the customer, the broker was free to, if you will, shop around and place insurance business wherever it was best for that customer. And in a way, those distinctions still exist, but in the day-to-day context of our business, we now use the word producer to refer to anybody that's in the business of selling insurance. Now, let me repeat. There is still a legal distinction between an agent and a broker, but for all intents and purposes, especially as you're preparing for your licensing exam, just think of producers, because both agents and brokers are subject to the insurance laws of the state they do business in. Both agents and brokers are obligated, both from a fiduciary capacity as well as an ethical and moral capacity, to respect the rules, if you will, not only of the insurance company, but of the customer. So there really is no distinction from a legal responsibility perspective between an agent and a broker. And if you approach the business from the context of being an insurance producer that has an equal responsibility to the customer and to their insurance company, then you'll do well on your exam. More importantly, you do well in your career.
All right, so here is the quiz, which is for insurance producers, the lesson we just did. The main purpose for errors and omissions is to provide to the producer. Remember, we just talked about producer, so we're calling ourselves producers. So I may change the name on my YouTube video to producer instead of agent. For those who are following along. All right. In its fiduciary responsibility to the principal, a producer is required to do all of the following except I would say solicit business. You're not required to do that. Okay, my guess. Okay, the purpose for policy summary, which must be given to every insurance applicant before the application is signed, is to disclose all hidden costs, explain the general features and conditions, explain the step-by-step process, provide buyers details of the specific insurance contract. Well, this is a tough one because it could be this. Explain the general features, benefit of the type of insurance. So I'm going to say this one, details of the specific insurance contract they are considering. Because they've already decided what they want. They're getting ready to sign it. All right, when first meeting prospective insurance applicants, a producer must give them a document explaining the general features, benefits, and conditions of the type of insurance being considered, which is called I don't know. I'm thinking policy summary or key points document. Let's see. All right, I got half of this right. So what did I get wrong? Nope, it's called buyer's guide. The general features, benefits, conditions are called a buyer's guide. Okay. The other one we got wrong, which I'm surprised. All right. It's the errors and omission covers damages that arise due to services a producer non-willingly failed to render. All right. So if I see that on the exam, that's the answer. All right. Question 2. I got it right. You are not required to solicit business that is profitable to the insurer. 3. Policy summary provides details of specific insurance contract they are considering for purchase. All of these questions here that we are going through could be on the exam. So we might want to rewind the video like I'm probably going to do myself. And I don't know. I think this one might be the next one. I don't know. I can't figure out where we're at here. Insurance contracts and regulations might be the next lesson. But stay tuned, following along. I'll see you on the next video.